Welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
Hello and welcome to the Prescribing Prosperity podcast with your hosts, John and Alex Soutsos. Guys, good to be with you again. How are you today?
Good morning, Bill. Everything's moving along.
Moving along in rocky waters somewhat. Alex, yourself?
Yes, the markets are keeping us on our toes.
They are indeed, Alex.
Yeah, I'm doing well, thanks, Bill. How are you holding up today?
I'm fine. To be honest, and we were talking about this a little bit before we started this podcast, I'm finding this environment a difficult investment environment to navigate and to sort of stay steady on, because I look at the markets, they're up and I'm like, oh, it's okay. And then they're down, and it seems the longer term trend is down. And then I think, no, and then they go up. So I'm glad I have you guys.
Well, we appreciate that.
Have you guys to talk to about this.
I've been through this a few times.
Indeed, you have.
There's an old expression, this is not my first rodeo.
That doesn't mean you haven't been bucked off the horse. So
it's very difficult. It's very difficult for everyone involved. It's especially difficult for the clients, the investors,
sure.
Especially if you're retired. You have fixed amount of assets remaining. You're no longer drawing a paycheck, and it becomes emotionally more difficult to cope with the ups and downs of the financial markets. But that's precisely when people like ourselves earn their keep, is to provide perspective during periods such as these, and to be able to be a sounding board and allow people to vent and get things off their chest when they're feeling frustrated.
No, and I think the one thing to remember, Bill, is everybody looks at the long-term charts. If you pull up whatever index or stock and you look at the long-term charts, like the S&P 500, for example, and you think about it and you see it's going up. But if you zoom in and you go on a year-by-year basis or a day-by-day basis, boy, you see a lot of ups and downs along the way there. It's not a smooth roller coaster ride to the top. There's or I shouldn't say a smooth roller coaster ride. Most roller coasters are not smooth, but it's not a smooth ride upwards. There's a lot of little bumps and drops and turns along the way, just as there would be on a roller coaster. And so a lot of people need to keep that in mind when managing their assets and looking at the financial markets.
No, it's really true. And that is kind of the perspective behind the backdrop of what you've been talking about for the last two podcasts. Is that this is not the first difficult time to navigate investments. In fact, there have been periods of times that have been very, very difficult. We left off the last podcast talking about the recession of 2007, 2008, and 2009. Where are we going to pick it up today?
Absolutely. So we're going to pick it up actually right there, just after the Great Recession. But as we discussed in the last podcast, and even the podcast prior to that, a lot of the events that unfolded were a response to changes in the monetary supply by the central banks, and raising and lowering interest rates over periods in time in reaction to market events. Anytime there's an action or intervention in the market, there's always reactions or consequences which emanate from those measures, and nothing ever actually occurs in a vacuum, much to people's dismay. They would like to think that individual actions, the central bank and the government would like to think that certain actions can occur in isolation, but that's never the case, unfortunately. So as we saw with the dot-com bubble, growth stocks had their values inflated and ultimately fell as rates began rising. So then they cut rates came down, and we saw a bubble get created in the housing market. Home buyers were able to take advantage of obscenely advantageous lending practices. And then as rates began to rise, the bubble burst. We had the Great Recession, and then in an effort to grease the gears of the financial markets and get things moving again and stimulate the economy. Rates were cut to near zero levels.
Mm-hmm.
And so as a result of that, at the end of 2009, moving in 2010, there were some consequences and some fallout to that action. And so for that, I'm going to turn it over to my dad. And Dad, why don't you take us from 2010 and get this thing moving again?
In 2009, obviously there was a presidential election. In 2008, a new president took over. In 2009, and events had already begun to unfold to start right-sizing the economy. All sorts of government programs were implemented to try and provide liquidity to the financial system. But the next shoe to fall following the beginning of the recovery with the Great Recession. So the epicenter of the Great Recession was in the United States, and the U.S. took aggressive measures to try and provide, as I said, liquidity to the financial system. Unfortunately, the ripple effects had already begun to spread out, and the seeds of the next crisis, which is the European debt crisis, were sown probably a decade earlier with the beginning of the European Union and the single currency, which was about 2000, 2001 in that time period. So the benefit to a common currency, obviously, it greases the skids for trade in Europe. Producers like Germany can sell their goods easily to other parts of Europe. And using a unified currency, other countries are able to buy their products without a problem. Now, the issue is this: Germany and France were on one economic plane, and Southern Europe were on a different economic plane. Germany and France were economically stable. Southern Europe, all of a sudden, when they went to a common currency, they essentially bought into the Deutschmark. That's essentially what happened. And they did not have the resources to maintain their standard of living. So you had a significant, I remember back then, family members in Europe saying, we now have to pay twice as much for everything, but our incomes haven't changed. And that's essentially what, and twice as much is just an estimate. It was probably more than twice as much in some cases. So places like Italy and Greece, Spain, Portugal, their standard of living was effectively cut. So what happened was, to compensate, the interest rates for these countries declined quite significantly, because all of a sudden they had the credit rating of Germany and France, which was significantly higher. And so they could borrow with significantly lower rates. And in order to maintain their standard of living, both individuals and countries began to borrow and spend. And that's the origin of the European debt crisis back in the early 2000s. Now, by 2009, we get to the point where Greece's government is spending at a rate that they cannot sustain, and they're also cooking the books, so they're not revealing the actual true state of their financial affairs. And so what happened ultimately is Greece revealed in 2009 that their stock of debt was 113% of GDP, with a deficit, a fiscal deficit of 13.6% of GDP. Now, let me put those numbers in context. Most developed countries operate with a fiscal deficit or surplus. These days, it's been mostly deficits, but the deficits usually range between 1% and 5% of GDP. Greece's fiscal deficit, in other words, the amount of money the government is spending above and beyond its tax revenues in a given year, was 13.6% more.
And hold on one second, Dad. Just to add further context to that, I believe at the time, the rules within the European Union were such that the deficit as a ratio of it couldn't be any, as a ratio of GDP, was not allowed to be any more than 2 to 4%.
Three, Greece, I believe, was the range, wasn't it?
Perhaps,
see,
but
I recall the number 3.
That's fine. So it's in that band right there. But the point is, when they initially announced what it was, and Greece had initially announced a figure that was in the range of 7%, and that was met with large response or a concerned response within the European Union. And then when the truth actually came out that, as you mentioned, it was in the neighborhood of closer to 13%, obviously that's when the excrement hit the fan.
Yeah, so 13.6% was the actual percentage, and the initial report was, as you mentioned, close to 7. It was actually 6.7. So Greece's credit rating collapses. Now lenders want much higher interest rates. This compounds the issue. We find Portugal, Spain, and other countries, the so-called PIGS, which included Ireland and Iceland and Italy, were in the same boat, and their debt was skyrocketing. Their interest rates were skyrocketing, and inevitably this resulted in the beginning of a major decline in the financial markets from April to July of 2010. Now, from peak to trough, we had declines on the magnitude of 13% in the United States by the S&P 500 index, minus 10 for Canadians investing in Europe, Australia, and the Far East. And worse, oil prices had begun to drop off. So we had a major economic dislocation. Interest rates were skyrocketing, obviously, in Europe. So Europe essentially did not cope with their inflated assets immediately in 2008, 2009, as the U.S. did. They were a little bit behind. The central bank was not aggressive enough in providing liquidity, and really the European Central Bank has a different role than the U.S. Central Bank is. In the U.S., all states are part of one country, whereas in Europe, you had every state, that being countries, had their own fiscal policy with one common market providing the monetary policy. This is not a sustainable arrangement. And in fact, Margaret Thatcher said as much when she was still the Prime Minister of the UK in the early part of the 90s. She said, giving up our currency and joining the monetary union, which had been discussed from the late 80s, early 90s, right up until the time it took place. Thatcher said she didn't want the UK to have any part of the monetary union. She wanted to maintain control of her own currency. And good for her and good for the UK, because that was the unraveling of Greece and the other countries, because now they could not compensate with their significant debt by devaluing their currency, which is what the normal practice is. And instead, they had to take significant budgetary cuts, a significant decline in the standard of living in Greece and in all those other countries, in order to get to right-size their financial situation. And it was very, very painful, and that pain remained for a very long time.
And so one thing I think is important to mention, just for listeners who may not have a full understanding of this. So when you have a situation where the government is overly indebted, what ends up happening when you have rising interest rates is you become unable to repay or refinance government debt. And in the situation of the fallout from the Great Recession, they were not able to bail out banks who had toxic assets on their balance sheets. And so at the same time, so the excessive sovereign debt led lenders to demand higher interest rates to account for the level of risk that was present in those economies. And so, as my dad mentioned, there's a lack of interest in investing or purchasing assets from those economies. And so in order to, what ends up happening is you develop a balance of payments crisis. So balance of payments is a financial term, an economics term for the difference between the level of exports and imports. So these countries who had the toxic assets and excessive government debt, the so-called PIGS, were in a situation where their balance of payments were grossly out of whack, where you had a significant difference between the level of exports and the level of imports that were occurring within the country. And so in order to stimulate exports, normally what ends up happening is countries will devalue their currency to make their goods cheaper on the market. It's the same thing as a company who would want to go out there and discount their products in order to make them more competitive in the in the marketplace. When it comes to a country and their economy, what they do is they devalue their currency in order to make their goods and services more advantageous and more attractive to foreign investors. And without the ability to do so, without the ability to control their own currency, these countries became uncompetitive and were stuck in a situation where they had a significant amount of debt and no way to bring in additional revenue in order to try and alleviate that debt burden. So I'll go ahead.
So in addition to that, the real estate asset values in Europe also began to fall in following the North American crisis, the Great Recession. And so the assets that banks were in Europe were relying upon to function began to diminish. And as a result, you ended up getting a series of cascading domino effect banking closures in Europe. Those most spectacular of which was Iceland, which their banking system just completely collapsed and froze. And you had several other banks around Europe that went through a similar situation. So this compounded
in Italy,
everything.
Yeah, and in Italy by mid-2016, 17%, approximately 17% of Italian loans were considered junk. So $400 billion worth of loans were basically worthless.
Yeah. Now that's several years later, though.
It is several years later, but it just puts into it gives a little bit of perspective as to the degree of the contagion with regards to the toxic or worthless assets that were on the books for some of these banks. I know that's a few years down the road, but it just gives a little bit of perspective so people can understand the degree to which this was impacting the different banks in these countries.
So the remedy was essentially government bailouts from the European Central Bank. When we say bailouts, we mean extending major loans to some of these countries. Initially, Greece was the principal utilizer of this program as they essentially went bankrupt. But Ireland received the bailout, Spain, Portugal. Austerity measures were imposed on all those countries. In 2011, the crisis deepened. Countries were struggling with debt. And the European Central Bank used the securities market program to buy bonds from those countries and to increase the confidence of investors. And Portugal at that point requested a bailout. Then Greece received the second bailout in 2012. The European Union adopted the fiscal compact, mandating stricter budget disciplines in Greece. And later in 2012, Spain and Cyprus requested bailouts. And the crisis continued, and institutions continued to work to try and to control it. And eventually, all of these programs did eventually create some stability, and the crisis slowly dissipated. Now, when I say dissipated, things were brought under control, but the suffering economically in those countries continued to this day. There's been a major cut in the standard of living. A quick anecdote during this period. So one of the things that people were complaining about at the time when all of this news was hitting the airwaves was that, oh, geez, these people in Southern Europe are not paying their taxes, and they're tax evaders, and they're retiring at age 50 and all of that. And I was perplexed by people's lack of perspective, because a lot of the people they're referencing in Southern Europe that were retiring in their early 50s and collecting a pension were government employees. And that didn't make them any different from government employees in Canada or the U.S., where they got to get their pension in their early 50s and have a decent lifestyle. Yet they were pointing fingers and being critical, saying, oh, these people are getting their pensions at an early age, and they're not paying their taxes. Well, there's a little bit of a difference between North America and Europe, especially Southern Europe, where the rule of law was not as adhered to as much, because there was a lot more recognized corruption in the political environment, especially in the southern countries. And so when people were asked to pay income taxes or any form of taxes in the southern countries, they didn't want to do so, because they knew that the politicians were taking the money and sticking in their pockets. It wasn't going to the common good of the entire society that everyone's going to benefit. They didn't have the mindset of us here in North America, where we know our revenues are going to the government, and at least most of it is finding its way to where its intended purposes, although I'm a little bit dubious as to how effective it is.
Most might be generous.
Yeah.
Some.
Yeah. So in Europe, they already knew their politicians and bureaucrats were crooks, and they didn't want to pay their taxes. So what happened is there's these car clubs in Europe, especially in Italy, with the exotic cars. And these exotic car clubs, like Lamborghinis or Ferraris, they would meet at these beautiful resorts in the mountainside periodically to compare and discuss their wonderful machines. And so clearly, if you own one of these exotic cars, you have a lot of money. So the Italian government during this European crisis, trying to find ways to collect more tax revenues, decides they're going to send their equivalency of the IRS or the CRA here in Canada up into the mountains to wait for these guys to arrive at their destination. So they set up shop like a toll booth further down the roads, and they got their roadblocks, and people are coming up, they're stopping, they're saying, "Oh, hi, good morning. This is welcome to the Ferrari car club. What's your name?" And they would get the person's name, and then they have the tax roll there in front of them. They say, "Oh, that's interesting, Mr. Lamborghini. It says here you make 50,000 euros a year, yet you can afford a Ferrari. How do you manage that?" And so they busted all these guys, and they began collecting tax revenues in a more significant way by doing things like that. And measures for tax collection became a lot more stringent in Southern Europe than they had ever been before, and they got a dose of North American taxation reality during that period.
I think it's also important to understand, though, that during this time, even though they implemented these austerity measures, and they obviously did have a positive impact from the standpoint that they were able to try and rein in some of the deficit spending that was occurring, it did result in a significant amount of political strife and political unrest. So for the better part of the next decade, if you will, both Italy and Greece, and I'm sure this was true for some of the other countries as well, went through a myriad of different governments. You know, I remember in Greece at certain points, and in Italy for that matter as well, there were periods of times where the government wasn't lasting more than a couple of months before it was being toppled by votes of non-confidence. And so you had this perpetual cycle of, new government gets in, people are still unhappy about the austerity measures imposed by the European Union, government falls. New government comes in, they promise different outcomes, the people are still unhappy by about the austerity measures, they get voted out, they fall, next government comes in. And so we had a period of turmoil, and in Italy it wasn't until recently that they finally achieved a certain degree of stability, but it was a very difficult time. And as you know, and as I'm sure our listeners are probably well aware, the financial markets do not like instability in politics. That can result in a great deal of volatility in the markets as well.
Well, political stability in Italy is an oxymoron. They changed their governments. They're like most people change their underwear, and that's been a chronic issue in Italy for decades and decades. I can speak with more detail about Greece because of my Greek heritage. And what was going on in Greece is the socialists, the left-wing political parties for years had grabbed power. And the way they grab power is in a country that had very limited manufacturing and other industries and were reliant primarily on tourism. They kept promising jobs by opening up the bureaucracy and creating more government work. And also they kept promising spending programs to get elected and into power. And eventually the right wing of the political factions in Greece were saying, well, if we don't start promising similar things, we'll never gain power. And so while the government switched from left to right a few times in the 10 years or in the 15 years leading up to the European crisis and the Greek bankruptcy, the right-wing political parties had essentially thrown in the towel, and they were right-wing in name only, or in very limited fashion, maybe from a social perspective, but from a fiscal perspective, they were spending just as much money to get the votes as the left wing was, and so essentially you lost that balancing force.
Yeah, so it's funny you mentioned that, because when I was researching the European debt crisis and doing a bit of reading on it. I myself was, just out of curiosity, I was trying to see which governments were in power at different times and what policies they implemented. And it's funny you mentioned that they started to blend into each other, because when I was doing my research, I was trying to figure out, this doesn't look like a traditional, conservative fiscal policy, or they all seem to be very one-sided and very similar. And it is in fact because, as you mentioned, they had both moved in that direction, and there was a lack of balance on both sides. It was very one-sided in terms of the policies that were being implemented, regardless of which party was theoretically in power. So
that's right. And the truth is, here in North America, the distinguishing feature from a fiscal perspective and fiscal responsibility between the left and right has begun to diminish now for probably 3 or 4 decades. The only difference between us here in North America and those in Europe is our fiscal capacity to borrow is much greater, especially the United States, because the US dollar is the world's reserve currency. And so this capacity to borrow and have interest rates that are competitively lower than most other places in the world has allowed this charade to continue in North America longer than it should. But we're starting to run into a hard ceiling in North America, especially in the United States. And this is where fiscal sanity really needs to start reigning. Otherwise, there will be future crises in North America, similar to what happened in Europe.
For sure. We're going to, unless you have anything else you want to mention on the European debt crisis, Dad, I'm going to transition us out of there. Was there anything else you wanted to cover?
No, that's essentially it. But as we've been learning over the last couple of episodes, one debt crisis bleeds into another because the ripples continue to spread.
Absolutely. So as a stone being dropped in a pond, the ripples extend across the surface of the water. So following the European debt crisis, we enjoyed actually a pretty spectacular run in the equity markets, including a secular bull market that began in April of 2013. Although some people will argue that the origins of the bull market date back all the way to 2009. But regardless of your desired start point, we enjoyed a pretty prosperous period in the markets. But what people sometimes forget is along the way there are some bumps along the road and some blips on the radar. And so one of those happened in 2015 when we had the economic crisis in China. So why don't you walk us through what happened and how the effects of that crisis bled over into the U.S. markets?
Well, just like in Europe, where the seeds of the crisis were sown a decade earlier, essentially a similar situation happened in China for different reasons. So China was a communist country for 5-6 decades. And having fallen behind the rest of the world, they realized that, and they began to liberalize their economy. Eventually, they got to the point where they began to allow a free economic zone in China to allow some free market economics to create some prosperity. And part of this objective to create prosperity was to move their rural population, which was China was almost entirely a rural population for the most part, to move them into cities. And so through the 90s and the early 2000s, there was an effort to do this, and coupled with some wealth that was created from the privatization of a part of the Chinese economy, there was a major effort to build new infrastructure and create brand new cities in China, or take older cities and modernize them. So there was this massive build going on from roughly the early 2000s to 2013, with the peak happening between 2010 and 2013. And yet all these office towers and commercial properties, residential high-rises were constructed. The demand for commodities increased during that period. So oil prices were rising as a result, and prices for steel and all these other things. That was actually a good period for Canada when all these commodities were in demand. But eventually, what happened was the Chinese economy collapsed under its own weight. The population could not afford to move into these places, and they were essentially many ghost towns. To this day, there's ghost towns in China from high rises that were built during this period that have not been occupied. Things have been improving a little bit, but this began to be a big problem. So oil prices then collapsed as demand for commodities fell off, and the Chinese stock market began to collapse as there was actually government encouraged speculation in stocks, because China did not have a stock market for the longest time. And then the Shanghai Index was opened during this period, and the Chinese, historically, the only place they put their wealth was in real estate. So there was an encouragement to create wealth through the financial markets, and so people started to speculate. And there was, unlike here in North America and in Europe, where institutions essentially are responsible for the majority of the trading on the stock markets, in China it was the other way around. It was individuals, and the individuals were just simply speculating on some of these nascent companies that were created during this period in China. So eventually the Chinese market peaked and collapsed, and we had a major dislocation in the financial markets. And the decline in Chinese economic activity reverberated over to the rest of the world. And from about August of 2015, August 1, 2015 to August 24, 2015, the S&P 500 index dropped 10%. The Europe, Australia, and the Far East dropped 14.3%. Oil during that period dropped 40%. The TSX here in Canada dropped 15.4%. It was an ugly period, but there was actually a rapid recovery by November of 2015. So in a span of about a month and a half, there's a rapid recovery. Most of the markets had recovered their losses. The U.S. had completely recovered. Europe, Australia, and the Far East were still down about 5%. But then, as things stabilized, they began to deteriorate again between November of 15 and February 11th of 2016. And then we had an additional drop in the market that was far more severe. In the U.S., the market fell nearly 13%. Europe, Australia, the Far East fell nearly 18%. Canada fell 15.4%. And oil continued to drop further. And in fact, oil had peaked out in July of 2014. And from 2014 until the end of February of 2016, the peak to trough decline in oil was on the magnitude of 70. That's minus 70%. So there was a stagnation in the economy. I remember this well. The U.S. and Canadian economies were very stagnant between 2015 and 16. The markets were doing nothing. Investors were becoming frustrated with 2 years of little returns. And this is all to do with the Chinese situation, which eventually was able to recover because China does control its own currency. So they had to devalue their currency to increase their exports. They did cut their interest rates. And so between those two efforts, eventually we had some stabilization.
Yep, absolutely. And now stabilization to a certain degree. We are presently actually experiencing some of the aftermath still of that overbuild that occurred in China during that period from when was it, 2010 to 2013. And so, or actually perhaps even sooner than that, you can trace it all the way back to 2000. So we're still seeing a certain degree of impact that is still being felt from those measures and the actions that took place back then. So during that time, tell us a little bit about how were your clients responding at that time? You mentioned briefly that they were a little bit upset, but how did they respond, and how long did it take for things to fully stabilize and recover?
Well, the period of turbulence was essentially between 2014 and 2016. And so essentially markets on a net basis ended up going sideways. Now, one of the benefits of running a practice is we investors don't buy the indices. They're invested in packaged instruments that are highly diversified and had included bonds. And bonds during this period were actually quite stable. At least North American bonds were actually quite stable. And they provided a bit of a cushioning. So just looking at some of our growth model was during that period, during the crisis fell 6%, which I would say was about half of the decline of the S&P 500 index, and probably 1/3 of the decline in the international markets. The balanced portfolio only fell 4%. So we really didn't have significant pullbacks in the investments that our clients were invested in, but they also were not growing. So there was some bouncing around for 2 to 3 years. And the net result was, although there wasn't a big drawdown, there was a lack of growth. And a lack of growth psychologically can also play a significant role in people's psychology and cause them to question what they're doing and how they're doing it. So it was a very uncomfortable situation. That bleeds into the next area, and that is the unfolding developments in the U.S. political scene in 2016, where there's a lead up to an election. Obama has finished serving 2 terms, so there's going to be a change in the presidency. And the markets were meandering until election night on November 8th, 2016. And it was a very unusual night. I remember it very well. When it was called that Trump was going to win the presidency, the overnight futures market dropped by its maximum amount permitted, which was -5%. But by morning, when you woke up, the futures market had completely switched, and the market ended up going up 2%. So that's a swing of 7% in a single night. So it was said at that time that the thought of a businessman taking over release the animal spirits of the business community. And so there was a big run in the financial markets from election night right through to the end of 2016, 2017, until the third quarter of 2018, when there was trade tensions between the U.S. and China, and that caused a 20% decline in the final quarter of 2018 before a quick recovery in early 2019 led to even better returns in 2019. And then that brings us into the beginning of 2020. And do you want to set the backdrop for that?
Yeah. So before we get to 2020, I just wanted to pull something up here to give people some perspective. So you mentioned the fact that we had from 2015 to 2016 and essentially a flat market.
Yeah.
There really wasn't a whole lot of returns to be had on the equity side. But as I mentioned, it depends on your perspective when it comes to gauging performance and gauging how well or poorly the market is doing. So if you look at that small period from 2015 to 2016, it was flat. But if you zoom out and you look at the whole bull market right up until the where we're going to get to, which is the 2020 onset of the pandemic, from 2013, April of 2013 until February of 2020, the market increased in the neighborhood of about 145%. That is a total rate of return. So that's even with a 2-year period from 2015 to 2016, or not even 2 full years, maybe about 1.5 years, where there was essentially nothing going on, and another period where there was a significant decline at the in the latter stages of 2018, going into the end of that year. I believe, if I'm not mistaken, Dad, that was the first time, or one of the first periods of significant rate hikes. Actually, I can quickly double check that.
Yeah, interest rate hikes began in
2016. I'm looking at it right now.
2016, yeah. Actually,
or 2015. Sorry.
December 2015 was when the first rate hike in the U.S. happened. It was a quarter point. Interest rates went from a quarter point. So this is now coming out of the Great Recession, free interest rate environment from 2009 until that period. So you had 5-6 years of essentially interest rates being zero.
Mm-hmm.
And so the first rate hikes begin December of 2015, and there's a quarter point rate hike. There was a gap between 2015 and 2016, and then there was another rate hike of a quarter point. And then through 2017, there were 3 more hikes of a quarter point each. So interest rates, central bank in the U.S. got up to 1.5%. And then there was 3 interest rate hikes in 2018 before the December one that added up to another 0.75%. Then the December one happened to bring it up to 2.5%. So there was a lot of strain. And in fact, I remember Jerome Powell was talking about raising rates throughout 2019, but that never materialized.
Yeah.
And the markets, as a result, began to recover because that big drop in 2018 in the last quarter during the tensions with China resulted in the economy weakening, so they didn't have to raise rates.
Yeah, so that's where I think again, some perspective matters, because when people hear what the Fed says, they come out and they make their announcements after their meetings. And Jerome Powell obviously has to convey the tone and the belief that exists within those meetings. What ends up happening afterwards is not always exactly according to script when it comes to what the Fed says. You know, what they say is not gospel, and what they say is not written in stone. And so, you know, for everybody who thinks we're going to be stuck at higher for longer, well, we may be, we may not be. We'll be higher for longer, and so long as the economy allows it. If the economy gets into a situation, as it may very well in the not too distant future, where it starts to slide back into contractionary phase, they may find the need to cut rates, especially as we mentioned in the last podcast, in the year of an election, or 2 podcasts ago. We mentioned we're approaching the year of an election, and so
the Central Bank of the United States is notorious for saying one thing and doing something else, especially during this period you're describing here in late 2018, where the rate hikes had already begun earlier in the year, and they were saying we plan to make X number of rate increases into 2019, and in fact they did not do so, and they ended up having to cut rates in 2019 3 times by 0.75%. So part of monetary policy is actually called a moral suasion, and that is to talk up or talk down the capital markets and the economy to behave before the central bank actually moves. And in fact, when we get to the present time, I'll touch on how the market moved even before the first rate increase took place in 2022.
Yeah. So as you mentioned, we had about I think it was either 4 or 5 rate increases in 2018. Obviously, the market started to move in the opposite direction as a result of those rate increases. The market dropped going into the end of 2018. So what did they do? They cut rates again, and we're back down to near zero levels. But that is not necessarily a direct response to the market correction that occurred in 2018, 2019. That ends up being in response to what unfolded next, which was the pandemic. And that was not a period that anybody was looking forward to reliving. I know myself, I found it difficult when I was preparing for the podcast to motivate myself to relive some of these details and the insanity that ensued over the previous 3 years. But obviously we have to get to it, and we have to discuss what exactly happened. So tell us a little bit about what happened in the lead up to 2020, and ultimately what unfolded in February and March of that year.
So what's interesting is there was discussion of this virus in China in late 2019 and early 2020. And in tracking the markets on a daily basis, I was surprised that there was no response in the capital markets here. And I was wondering, okay, well, this sounds serious, but the markets don't seem to be worried about this, and they seem to be shrugging it off. And so there wasn't any extraordinary actions that we took on our part. We carried on. And really when things hit the fan was when there was discussions of closing the borders to airplane travel and restricted movements. And eventually the 2 weeks to slow the spread talk in March. And during this period, as fear mounted from the beginning of February up until let's 2 weeks to stop the spread. The virus was spreading rapidly. You got all this news showing people dying and people in hospitals and hospitals being overwhelmed, and the markets began their collapse. And it was a very rapid. It was a waterfall collapse that took the market down over 30% from peak to trough from the beginning of February till the third week of March, before the central bank had to step in and announce major rate cuts. So in March of 2020, you had an initial cut of 50 basis points on March 3rd, bringing the interest rate down to 1.25%, and then you had another cut of 100 basis points, bringing the interest rate down to 0.25% in just 2 weeks later on March 16th. And with those interest rate cuts, there was a rapid rally and recovery in the financial markets. But interestingly enough, the sector of the market that rallied the most was actually the most aggressive sector, and that's the tech sector, because these are what we call in investment parlance long-dated securities. So their growth, the growth of their earnings is longer in the future. And when you have zero interest rates and you discount that future growth to the present, the lower the interest rate, the more valuable those future cash flows are. And so you had a massive rally in software and technology through 2020, bringing the market up into a nice place. In 2021, more of that continued. And then in late 2021, we had a situation where Powell and the central bank began saying that rates are going to have to go up, and things began turning nasty in 2022. And
hold on, you're moving at a rapid pace here, so we're going to get to 2022 in just a moment. But just to give some further context, we had March 16th of 2020, which was according to some people became known as Black Monday 2. That's the Roman numerals 2, not TOO. And so Black Monday 2 on March 16th, the S&P, or the Dow Jones, fell 12.93%. So it was another big day in which there was a major move in the stock market as things began to shudder around the world. I believe it was on the next day, the Tuesday. Actually, maybe it was the Wednesday. I think it was the Wednesday when the NBA shut down. And I remember it was actually after a hockey game when I was sitting in the dressing room and we got the news alert, and we all looked around and said, this might be the last time we see each other for a while. And in actuality, that team I was playing on at the time never got back together again. We still haven't played together since then, but it was a strange time in the markets. Obviously, there was a lot of uncertainty with regards to what was going to happen, and so the economy was shut down. And obviously, when the economy gets shut down, that's negative for the financial markets. At the same time, or shortly thereafter, we also had the Russia-Saudi Arabia oil price war, which contributed to a decline in the equity markets as well, as that created additional instability. It also significantly reduced the price of oil on the market. And then, as you mentioned, we had the significant rate cuts that happened in 2020. And then at the same time, we also had an unprecedented degree of government stimulus, which occurred during that period. And that was not limited to just the United States. We saw it here in Canada, and it was similarly echoed across the globe as other countries and other governments provided financial liquidity into the markets and injected money into the economy by providing people with essentially pandemic relief funds, which then were used to plow back into everyday spending and purchasing and consumption. And that ultimately led to what ended up unfolding in 2022. So why don't you explain how that stimulus and how those rate cuts contributed to the events of 2022 when we experienced yet another market correction?
Well, first of all, the thing that I recall throughout that period, especially when the announcement was made 2 weeks to flatten the curve, I sent an email to a colleague. I said, the cure cannot be worse than the disease. There are no right or wrong answers in economics. We only have trade-offs. And my background in economics and my experience in the financial industry taught me that the economy is very intertwined, very delicate, and the supply chain is, everyone's reliant on each other, especially in a world of globalization that's taken place over the preceding 25 to 30 years. So to shut down the economy completely, I knew there were going to be significant economic reverberations, and it was likely not a wise move to be making at any time in human history. And at that time, I reflected back over the preceding 100 years, and there had been numerous pandemics, including a polio pandemic throughout the 20th century, yet the economies were never shut down. There was a world war in 2018
ended in 2017.
1914 to 1918, there was a world war, and you had there was a pandemic during that period, and the global economy was the Spanish flu was never shut down, and there was a variety of other smaller pandemics throughout the 20th century. It was never shut down, and to shut down for an airborne virus, to me, did not make sense, especially a coronavirus, which is essentially a cold virus that mutates rapidly. So it's unlike other diseases that where the bacteria or the virus is stable and you can create vaccines that eliminate the risk. It was a cold virus. It's constantly mutating, so it's a moving target. And it's very just like the flu virus. It's a moving target. Every year they come up with new concoctions, and only 1/3 of it is effective. So to shut down the global economy and disrupt everything, the supply chains, was a massive, in my opinion, at the time. I thought that was going to be problematic, and we saw it was very problematic. Toilet paper became so very valuable, of all things. People didn't want to go without toilet paper. So the breaking down of the supply chains created a lot of distortions in the economy and created a lot of inflation in the economy.
And you have to remember the fact that, you know, the economy is not like a faucet, and the global supply chain is not a faucet where you can just turn the tap on and off whenever you feel like it, and water appears and water disappears at a moment's notice. It's more like a 250 car train that is riding along on the rails, and all of a sudden, imagine a giant just stuck their hand in front of the train and stopped it dead in its tracks, and you're going to get all the previous cars which are coming along behind the train are going to start crashing into each other, and there's going to be spills and leakage everywhere, and it's going to take a lot of time to clean up that mess and get the tracks cleared in order for the rail line to reopen. And to a certain extent, we still have not achieved that. You know,
the mess has not been cleaned up to date, and it's hard for one central authority to clean up that mess. Essentially, the central banks of the world, led by the United States, cut rates. So they created what the monetary stimulus. This created this great demand, yet the economy was, for the most part, closed, and people had very few places where they could spend money, and where they did spend money, prices skyrocketed. Mm-hmm. And we created this inflation. At the same time, you had fiscal stimulus, so governments borrowed money in order to compensate people for the fact that some of them could not work, and that created more demand. And there was, again, still limited supply through this period. So all of a sudden, we have these massive expenditures, both by the monetary authorities and the fiscal authorities, and that created this wave of inflation that we've seen over the last several years.
So hold on. Let me pause you for a second. Sorry, just before you discuss that. So you talk about the stimulus that was injected into the economy. So first of all, you have people are receiving additional money. So that's number one. Number two, you have people who are not going anywhere. So regular expenditures on things like travel, commute times, gas money, car insurance, all of that goes away. So people have more money. So you have more money that way. Number three, you have fewer goods that are being produced because you shut off the supply chains, because you have production being shut down because companies are not going into into manufacturing or into whatever industry it is. They are not producing goods and services. There are fewer goods that are in the economy that are available for purchase, and at the same time, you have more money that is chasing them. I've already isolated 3 different examples of how there's more money, and not to mention the lower interest rates. So people who are on things like variable rate mortgages, they're seeing their cost of living go down, and so you've got more money chasing fewer goods, and what does that result in?
And that
Inflation.
results in inflation, and an inflation that has permanently reduced everyone's standard of living on a cumulative basis in the magnitude of about 20% over the last several years. And the inflation is not yet over. The rate of change in prices has peaked in 2022. It's been coming down, but it's been coming down only because the central bank started to raise interest rates to choke off some of the demand. Unfortunately, the people in charge of fiscal decisions in North America and in Europe have not stopped spending money. And in fact, there's a major stimulus program in the United States in 2021 that is responsible for the continued excess money in the financial system, and that's causing what they call sticky inflation. People are saying, why is it inflation is so sticky? Well, it's sticky because you have 2 opposing forces. You have monetary policy that's trying to reduce money supply, and you have fiscal policy that's expanding money supply. And so you have these 2 major opposing forces, and inflation is sticky. That being said, inflation has now begun to drop on a year-over-year basis to a point where it's starting to be within the historical range. But the damage has now been done. It was done in terms of the cost of living for everyone has increased on a permanent basis, but the damage was also done to the stock market. So in late 2021, the market peaked. In 2022, the central bank started talking about pain coming with interest rates are going to go up. And these repeated warnings by the central bank that rates were going to go up in the early part of 2022 began to find their way into the psychology of the stock market. And so the stock market started to decline quite rapidly basically from New Year's Day in 2022, and eventually bottomed out in the summer after declining roughly 19 to 20% if you're using the S&P 500 as a yardstick.
Actually had a double bottom because they bottomed again in October.
Yeah. So there was a bounce into August of 2022, mid-August, and then you had another major central bank meeting where Powell threw
Jackson Hole.
Jackson Hole. He threw cold water on everyone's enthusiasm and brought the market back down to its previous lows by mid-October of 2022. And we're now a year removed from that, and we've continued to have a central bank that continues to be belligerent toward the capital markets, and that's why we're struggling with what's going on in the financial markets right now. That coupled with obviously the development of regional wars in Europe, Russia, Ukraine, and the attacks on Israel more recently, and so this is all creating distortions and concerns in the capital markets, and it seems to be never ending. Yet we have put the microscope or the magnifying glass, I should say, on all these crises over the course of the last 40 to 50 years, and we've explained in great detail the negative impacts. But over time, gradually, markets eventually recovered, and as Bill was saying at the start of the program, this is where the financial advisor earns their keep, is they provide the perspective, and they make sure the asset mix is appropriate for the individual in order to allow them to stay in the game and not pull out at the wrong time. And so this is the value of having a detached, someone who's emotionally detached to be able to provide perspective. And that's what we're doing right now for our clients.
Emotionally detached, and also has the benefit and the knowledge of what has happened in the past. Because what ends up happening a lot of times with investors, individuals who have not studied in great depth what has happened historically in the markets, they end up with a bit of a myopic perspective. Even if they've lived through prior market crises, there's always the immediacy and the recency bias of looking at what's occurring right now and projecting it into the future and saying, the markets collapsed last year. Last year the market dropped almost 20%, and therefore I assume that the next year it's going to drop another 20%, which isn't necessarily true. You need to understand what the context of that decline was, what caused it, and how it fits into the broader perspective of market history. So just to put some statistics to it. So as I mentioned, last year the market declined 19.44%, almost 20%. Where in 2020 it had gone up 27%. So you had a spectacular, or 2021, excuse me, you had a return of 27% on the S&P 500. So you had a spectacular return followed by a spectacular collapse. And so, depending on which time period you're sampling people's opinions in, if it's 2021 and you ask them, what do you think the market's going to do next year? It's going to be great. It's going to go up another 27%. If you ask them at the end of last year, a lot of people were saying, oh, it sucks. The market's going to take another dump, and I'm going to be broke and living on the street and begging for money at the lights and offering to wash people's windshields. So, that's where, as my dad mentioned, it really is important that you have somebody who can provide you with an honest and objective perspective and give you a little bit of an understanding as to what is happening right now, where we are in the cycle, and what is likely going to be the outcome, not just in the immediate near term, but in the intermediate and longer term as well, because ultimately as investors, you're invested for the long term, and you need to maintain that perspective when you are evaluating your portfolio. So before we get into a recap of everything and some common themes and takeaways, I just want to get your perspective, Dad. What were your clients saying, and what was their response to what happened in 2020? And then you can also add in their response and their reaction to what was happening in 2022.
Well, I think people's reactions in 2020, they were more overwhelmed by the pandemic closures and the inability to move around. And because the central bank jumped in quickly in March to right size the financial markets, and there was a nice recovery in the second half of 2020, there wasn't as much concern about the financial markets in the second half of 2020 as there was a big recovery. 2021, again, another big run up. So people were more focused on the problems with not having their freedom and being able to move around during 2021. But I think we're beginning to see the unraveling of the pandemic impact more so in the last year and a half. So it wasn't 2020 where we saw the negative response by investors and clients. It was in 2022 and 2023 that we're seeing the negative response. And people are nervous right now. They're very nervous. I try and repeat things I've said in the past, which is that as long as people are alive on the planet and they're spending money, someone is earning that money and creating goods and services that create value and that create cash flows and revenues, and you can buy shares in those businesses. I like to point out that consumer staples, which are the things that we rely on to survive, food, beverages, the supermarkets that sell these things, they have a perpetual demand, regardless of what's going on in the world. And then, of course, you have the aging demographic in the world, especially in Western Europe and North America, that's creating pressure on the medical system and healthcare. And so there's increasing demand in that industry. So you have a lot of that. And there are other industries that are benefiting as well. We see the continued evolution of the technology industry. And industrial companies are also producing goods and services that are being utilized. So business continues in spite of all these problems, in spite of short-term impairment due to a constraint on the money supply, which is what's going on with central banks raising rates. All of these impairments are temporary in nature, and we're trying to put things into perspective for people and to let them realize that it's going to pass. This is not forever, and it's just a matter of trying to maintain your perspective and not pay too much attention to the mainstream media, which is focused on clicks and emotional swings to increase viewership. So that's what's been going on. It's been a great challenge. Our portfolio did very well through 2022. 2023, things have been meandering sideways for obvious reasons. We've had what I call the iceberg market in 2023. You have 7 to 10 companies that are above water and 490 companies that are below water. And the S&P 500 index is not really indicative of what's really happened in the market in 2023.
Yeah.
So
if you pull out the Magnificent Seven from the market returns, the market is actually in negative territory.
Yeah,
over 2023.
That's
And I think
right.
a lot of people forget that. I had a client meeting recently where they wanted to know, why is it my portfolio has kind of gone sideways over the last year, but I see that there are other ETFs or other stocks that have gone up. And I said, well, no. And you and I have talked about this, and we've mentioned it to multiple clients. It's not specific to this one client, but not all industries and not all stocks can lead 100% of the time. There is always going to be rotation. There's always going to be periods in which certain sectors are more in favor or more in vogue. And as a result, that's why you need a well-constructed portfolio. And what you want is a portfolio that over the long term has, as you mentioned, perpetual demand, minimizes the level of volatility in terms of the stocks and industries that it's invested in, and is able to generate a positive return over a full market cycle and not just in small periods of a year or 6 months. You need to have a long perspective in order to be able to fully evaluate the performance of a portfolio and of a portfolio strategy. And so with that, I'm going to do a quick little learning takeaway session with you here, Dad. So obviously, since we began, we've journeyed across 50 years of market history and covered 12 different crises, actually 13 different crises. And obviously, each of these crises has had their own unique attributes and causes. But can you recap what overriding themes were consistent across all of these different events?
The overriding theme essentially is dislocations in the financial markets are usually triggered by actions taken by governments. So when governments intervene in the free market system, they create dislocations and demand and supply, and like we said, the proverbial stone in the pond, there are ripple effects. And in the wake of these ripples, which are not ripples in the financial system, especially when you shut down the global economy, that becomes more of the wake of a speedboat.
Tsunami.
Or a tsunami. There are massive implications on the economy. And this has been going on for decades now. Constant interventions by governments with fiscal policy or monetary policy. We saw in the early 80s, in response to the inflation of the 70s, a massive cut in interest rates. And initially a major increase in interest rates, which tipped the economy into recession, and then a recovery from that created some prosperity for most of the 80s, only to be followed by interest rate increases at that time to trigger another decline in the early 90s. And then you had wars taking place in the early 90s, and then you had bubbles being created in stocks and real estate as a result of the up and down yo-yoing effect of central bank policy and fiscal policy over the course of time. I think looking back over the last 50 years, the period of the greatest amount of economic sanity was in the latter half of the 1990s, where in the United States, you had a split government. We had a Democrat president and a Republican Congress, and they came to an agreement to cut government expenditures. Mm-hmm. And that triggered a surplus in government revenue, and it created 5 years of enormous prosperity in the financial markets. And I think we are approaching that point now in the United States with a split government. And over the course of the next few years, we hope that they have some fiscal sanity that returns to them and monetary sanity, so that we can have another period of prosperity. But the common theme over this period has been government interventions, central bank interventions, and military conflict. Those are the things that typically trigger crises and create problems.
And so one of the, what then would be the takeaways or some of the important concepts that we can provide to investors?
Some of the takeaways involve it when it comes to first of all, as an investor, growth of capital begins with the decision to save. So first of all, you have to save money. You can't spend everything you earn. Once you make the decision to save, the next decision is where do you put those savings? And history has demonstrated that the ownership of business is the greatest wealth creator in the world. And so you need to own some high quality businesses. The other item that needs to be actively discussed is the fact that there are inevitably going to be things that occur geopolitically, internationally, that come out of left field that you don't anticipate. And that is where the greatest risk lies in the capital markets, is the unknown. What is already unfolding at the present time is already known, and the capital markets have already responded to it. So we talk about the wars. Well, now that the war in Israel has begun, that risk has been priced into the market. The war in Russia and Ukraine, that's already been priced into the market. Everything that is already known, all those risks are always priced into the capital markets. It's the unknown that is the greatest risk, and obviously that you can never anticipate that. So your portfolio has to be structured in such a manner as to be able to withstand these unanticipated events. And that is where portfolio construction is very critical, and that's where we can add significant value.
Okay. Well, you preempted my question, which was going to be, what can investors do to help them prepare for future market volatility?
So it's all about portfolio construction. The investment industry in North America has commoditized over the last 25 years. It seems that everyone's all in one portfolio solution, the proverbial balanced portfolio. They all look the same now. And essentially, these balanced portfolios are designed to try and minimize the impact of the disruptions on a person's investments. Unfortunately, by virtue of pursuing that strategy, they also minimize the potential to actually create wealth. And so most investors are caught in a trap where they need more capital growth than they have experienced up until this point, but are being frustrated by portfolios that are extraordinarily diversified to the point to minimize the volatility of the capital markets. And so you end up getting a very limited growth, and people are getting frustrated. So this is where portfolio construction is very important. You need to be somewhat creative in the way you do things, and in order to create that potential for higher returns in the future. And that's what we're working on.
Yeah, we've tried to take a very deliberate approach to creating a more unique portfolio construction that helps remedy some of that lack of difference or that lack of return that has occurred as a result of the commoditization of the financial industry within North America, as you mentioned. Now, the other thing I was going to say that also is important to help people prepare for future market volatility is to ensure that you have somebody that you're working with who can help you navigate those times, who can help, give you the correct perspective and perhaps the correct discipline when it comes to not getting caught up in the events and the minutia of what is happening on a day-to-day basis. And that's where we come in. If anybody is interested in reaching out to us, we're going to mention what those avenues are, but they're welcome to do so, and we can work with individuals to try and help them achieve their financial goals, and also help guide them through difficult market periods such as the one that we're living through at the present.
I'd like to wrap up my comments by quoting billionaire entrepreneur Peter Thiel, who said, "Brilliant thinking is rare, but courage is in even shorter supply than genius." Peter Thiel doesn't believe in copying the competition. He believes in creating a new path. And that's what MedWealth is all about, is creating a new path for portfolio construction.
Absolutely. I think that's a great place to wrap up. So in future episodes, we hope to bring on some historians to help us tackle subjects such as the Great Depression. But I think we're going to leave the market history for at least a couple episodes now, just so we can refresh people's palates and talk about some other subjects as well. Next episode, we're going to be joined by my friend and colleague, Skylar Senkowski, to discuss cryptocurrency and blockchain technology. It's a burgeoning field which will likely impact us in the not-so-distant future, I think much sooner than a lot of people realize. So that should be a very interesting discussion, and I encourage people to tune into that next episode. But for now, I'll thank you, Dad, for providing your perspective on the last few episodes and your experience, and I'm going to turn it over to Bill to wrap things up.
Thank you.
And that was great. Thank you, guys. I really appreciate that. And I can't wait for the next podcast, actually, because I'm not a big Bitcoin fan, but I am a really big blockchain technology fan. And I think a lot of people do not understand the dramatic, incredible implications of blockchain technology. So I really look forward to that discussion in the next podcast. This has been interesting. It's been good. And it's funny, John, I was sitting here while I was listening to you talk about portfolio allocation, thinking, but John, the 60-40 portfolio has betrayed us this year. And as I was thinking that, you went right into that, saying, yeah, you got to get a little creative, and you've got to recognize that what has always worked doesn't necessarily always work. So
last year as well, you think about the bonds are supposed to be the protection in a portfolio, and last year bonds declined in the neighborhood of 15%, if I'm not mistaken. So
it's been a cumulative decline over 3 years of 15%.
Wow.
Last year, I think the number was in the order of magnitude of about 15%. Our bond portfolio did not experience that. Fortunately, the construction has offset that, but for the most part, if you're relying on traditional bond methodologies, you've been hurt very badly, and you need a different form of risk mitigation.
Well, as always, let's wrap this up by asking you to tell folks who are interested how they can get in touch with you and reach out to you. Maybe have a further conversation on a personal level with you guys.
Absolutely. So they can reach out to us anytime at info@medwealth.ca. That's info@med-wealth.ca for a free portfolio analysis, or just to schedule a meeting to talk with us. They can visit our website at medwealth.ca. That's med-wealth.ca. And they can also reach us on X, LinkedIn, and by phone at 905-568-2000 or 1-888-568-1170.
By the way, just sorry to interject here. People can also sign up for our weekly newsletter that's produced, which provides commentary on what's going on in the capital markets and the global economy in a manner that is perhaps more insightful. So if people are interested in just signing up for the newsletter, they can go to our website, med-wealth.ca, and do that.
Fantastic. Well, thank you. Thank you for the conversation. And listeners, thank you for taking the time to listen today. We hope this was a useful and informative conversation for you. I know it was for me. Gave me some flashbacks too, as a matter of fact, thinking about some of these financial crises. But thanks for listening. If you're not a subscriber already, hit the subscribe button. It's easy. Then you will never miss another podcast from John and Alex. It will be delivered to the listening device of your preference, and you'll always be tuned in. If you like it, like to come a podcast, we humbly ask that you rate it and maybe recommend it to other people, help spread the word about what John and Alex are doing here. On behalf of everyone involved, I'm Bill Tucker, thanking you and reminding you, do not wait to live your best life. Live it today.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.